Hello, everybody, and welcome to Arrive's Property Selection Strategy webinar. We'll give folks a few more moments to hop into the virtual room here today. Quick note, Jake P., our head of operations at Arrive, will be in the chat. He will either be answering your questions live or teeing them up behind the scenes, where we will have live Q&A at the end with both Cameron and Jeff. So in the meantime, would love to hear where you all are tuning in from in the chat. I am tuning in from, it was snowy Seattle. So I'd love to hear where you all are. Looks like we have California, San Fran, Lake Tahoe, Alaska. Wow. Atlanta, Miami, New Jersey. Great to have you. Texas, Miami. We've got some Miami folks. South Carolina, Fair Oaks, Cali. Keith, great to see you. It was great to meet you too. In Scottsdale. We have our Jeff, who you all meet here soon. Las Vegas, Oklahoma. Wonderful. We'll give folks a few more seconds to hop in here. Thrilled to have you all today. Our investments team will be walking through our property selection strategy at Arrived. We have SoCal. Welcome, Thomas. Welcome, Victoria. We have some teammates in the house. Victoria is our business operations coordinator out of Arkansas. Indiana, wonderful. Great. Well, I think we have most of the folks in the room. Would love to hear still where you all are coming in from. Yes, definitely, Jill. Very cloudy Seattle today. We got Bloomington in the house. Wonderful. All right. Welcome, everybody, to today's Arrived Property Selection Strategy webinar. Before we get started, I would love to do brief intros. Again, my name is Corinne Headland. I'm head of investor relations team here at Arrived Homes. I'm also joined by Jeff Talbert, our Director of Investment Valuation, and then Cameron Wu, our VP of Investments. Would love to set the stage with a quick agenda so we're all aligned on what y'all can expect for today. We'll be walking through the acquisition process, selection process. Jeff will be walking through long-term rentals versus short-term rentals, and then we will have a live Q&A session at the end of prepared remarks. Quick note on questions. We'll be hyper-focused on the strategy questions themselves, so feel free to drop any that you have in the chat. Jake will either answer them in chat or we'll tee them up for more color to be added to them during the live Q&A. So I would love to welcome Cameron Wu, our VP of Investments, up to the stage.
Hey, how's it going, everyone? Hope you're doing well. Thanks for joining us. Always love having y'all on and doing these webinars. And today we are really focused on the properties themselves. So we're just exposing some of the inner guts of how we operate internally. We're going to talk about investment products and differentiations and thesis and strategy. So it'll be a real informative session today that talks a lot about real estate and focuses on the why, right? So a good place to start is just the general investing process, right? If you are doing this on your own and you're taking your own capital and you're trying to invest in a property, here's a rough outline of what you go through. First you got to decide to invest, and it's easier said than done. Then you got to research properties, find a lender if you're going to be using debt, tour the homes, make offers, hope it's accepted. And in the environment right now, it's certainly challenging, right? We have a lot of properties falling out due to financing and just generally in the market. You have to have the down payment. And if you think real quickly about an investment house, let's say that you're investing in a $200,000 property, which by today's standards is very entry level. And with a down payment, you often need about 20%, and then you need additional cash, for rehabs, your cash reserve, closing costs, etc. So roughly you're going to need about $50,000 just as a down payment on an entry level investment. Then you have to go through the closing process, you get insurance, you go through renovations. And for the last 2 years, it's been really challenging finding labor, right? General contractors, subcontractors, all in high demand, all very hard to find, all very expensive compared to what it historically has been. Then you got to go through the property management process, marketing it, listing the home, showing the home, getting a lease signed, dealing with an actual contract. manage the accounting on an ongoing basis, organize taxes, do the banking, et cetera. So it's really quite an involved process. There are generally three requirements that we think of in Arrived. It's you have to have enough capital, you have to have enough time, and you have to have enough expertise to be able to have a chance at really successfully investing in real estate, right? There's a lot of legal jargon. There's a lot of just things at risk, capital at risk, credit at risk. So it can be a challenging environment. So let's move on to our underwriting process at Arrived. So we kind of break it down into a couple steps. In underwriting, we refer to as the process of evaluating assets to see if they are suitable for the investment products that we're offering. So first we ingest them. And what do we mean by ingest? Well, there's a whole world of real estate investments out there. And how do we determine what is suitable for us? Well, we have to understand what's available out there. So we have to ingest the world of opportunity into actionable data sets, actionable assets that we can perform analysis on. Then we narrow them down. So before we run everything through the ringer, we kind of have a buy box that says, the entire world of assets is not open to us. We have more specific requirements of what we're looking at. So we have some kind of attributes and characteristics that we mechanically narrow down on. So that might be like a bedroom count. So we're generally looking for 3+ bedrooms for long-term rental products. And then for short-term rentals, generally 4+ bedrooms. Then we analyze step 3, the actual properties that meet that buy box. So that involves going through revenue projections, expense projections, rehab projections. It's really looking at, well, what works. For visualize, this can also really be thought of as passing the human sniff test. We use all sorts of tools available to us, like Google Maps, and really putting ourselves in the shoes of an individual shopper, saying, like, what does this look like? What's the neighborhood? Are there any traps? What's the location? Computers are great at a lot of things. Systems and technology are wonderful. Even with things like ChatGPT, it can offer a world of information, but there's still not quite the human touch on all of this. And that's what we're really spending a lot of time on. I would say that most of our time is spent on number 4, because that's really what makes the difference between a good investment on paper, which we figure out in step number 3, but what's a good property in reality. And that's step number 4. And that just requires a lot more processing of visual images and just understanding of the asset. So that's what our team spends a lot of time on. Then we lever the investment, or at least we evaluate whether we should lever it. And the reason why it's in the underwriting process as a step, taking a loan out can seem like more of a chore or a necessary step that has to be done to be able to get enough capital to purchase a property. But in this case, we think about leverage as an economic tool. Right. So when you lever a property up, you're changing the inherent economic characteristics and the return potential. So we evaluate it. We look at the cost of capital, the interest rates out in the market today, and we look at the kind of the appreciation potential, the dividends, and the full economic profile, and decide, is it smart to put leverage on it right now? And a lot of times the answer is no in today's market because the interest rates are too high. So you'll see a lot of our properties are fully funded in cash. With that said, we have strategic refinance of options, available, such that when it is more advantageous to take out debt in the future, then we can implement that tactically and then go from there. And then finally, refine. Really getting down to the offer, right? And how do we refine the offer process? Once we know we want to make an offer on a home and acquire it, what's the way to strategically approach dealing with the seller? And that's kind of the fun part too. And that's where we work with our brokers, who are all locally managed and locally licensed. So they are our partners to do the actual, tactical negotiations. All right. So asset selection, just, what does that funnel that I just described in underwriting lead down to? So we did some analysis on our world of data that we collect about how we underwrite. And, we kind of normalized it to some rounder numbers, but, proportionally, this is correct. So out of about 100,000 total properties that would have been ingested and come into our system, about 10% of those pass data screening. Right. So then from that point, we're saying, okay, now let's really look at these rents, go over them with a fine-tooth comb, look at the expense profile, and then look at the rehab projections. And then 0.5% of those met the team standards in the sense that, okay, passed the visualization, decided whether we're going to lever it or not, and then now we're going to offer on it. And then we purchased 0.2% of that. So, you can think about that as offer rates, acceptance rates, but more or less it shows the pickiness, the selectivity of our investment process. And it is pretty selective, as you can see, 0.2% of what we could, analyze, we end up purchasing. So, that's a little bit high level, and we can certainly go into more details with Q&A, but that's what the the asset selection process looks like. Now, how does this thread in with the qualification process, and call it the SEC process, just to kind of highlight what it really revolves around, which is this idea of making a company a security. So, just to summarize what we do and put it in the context of the general arrived process, we're doing all this underwriting, we're doing these negotiations, but simultaneously, we're also working with the SEC to qualify these as securities so that the public at large can invest in these properties. So, I describe underwriting, purchasing, and then once we pass due diligence, in the sense that we are committing to purchasing the property. So, and just as a quick review, let's say you're going to buy a property. Over a 45-day period from the time you go under contract to the time you're going to close is that 45 days. And after 14 days, you're going to commit to buying the property. That's that due diligence period. You're reviewing everything. So once we go past that date, then our deposit is at risk, the earnest money. So, for us, it is, it's a decent sum of money that we would certainly not want to lose. But by this time, we've gone through the full due diligence process to make sure, yes, we can rent it out. Yes, this is a security that works, the kind of full shebang. Then at that point, we start the qualification process. And this is where we collaborate with the SEC to bring it to market. So as a quick high level, what they do, we file it with them kind of on that second row, then review time for the SEC. So they're looking over our documents, and we've gotten into a good cadence with them. So most of 2022, we were releasing properties, getting them qualified on like a 7-day turnaround with the SEC. So we would submit it to them, and then 7 days later, they'd say, hey, everything looks good. Go ahead and start selling. And that's when they would arrive on the arrived platform. That pun was not intended, but that's how they get there. So with that said, that's a very high level overview, more of the acquisition process, right? And underwriting, and just a little bit of the internal guts of how our team operates in acquiring properties. Now, Jeff's going to talk about the strategy. So there's no person that I trust more than Jeff to really understand what is valuable and which asset matches which investment strategy. So he's going to talk about our two products, vacation rentals and long-term rentals, and really go into more of the guts of why we buy homes for certain different products.
Okay. Thank you, Cameron. I appreciate the vote of confidence there. So Cameron talked a little bit about that, about how picky we are, and how many things we look at versus how many things we buy. So I'm going to take a few minutes to go through the differences between long-term rentals and vacation rentals, and more specifically really kind of dig down into some of the examples of why we would or wouldn't go with certain kinds of assets. So these are kind of just like a very high level overview of long-term versus short-term that we think about internally. Obviously, both are residential assets. Both are residential assets. So obviously, you have tenants in both of them. One of them is usually staying for a year or more, ideally 2 years or more with long-term. And vacation rentals, obviously, it's nightly. Long-term, we think about long-term more as core housing. So we think about it in terms of just, obviously everybody, needs a roof over their head. It's typically in a suburb or near a major city, lots of infrastructure around. Versus vacation rental, we're not as focused on the surrounding area services and things like that. Obviously, vacation rentals can be a getaway from the big city and from population centers. This is a really important one, that long-term rentals are a mature and seasoned industry. And this has been in focus a lot recently. Long-term rentals, if you zoom out a lot, is actually a pretty new industry, but it's going on, 10, 15 years now. And a lot of it, it is maturing and growing very quickly, but a lot of it is just getting more formal. Whereas vacation rentals is still the Wild West a little bit. There are people who have been doing it now for 10 plus years, but those are very few and far between. And there's a lot of opportunity to innovate in the vacation rental space. And one thing that we do is we put a lot of creativity, of thought into what we're buying for vacation rentals. There's not a playbook that you necessarily have to follow, so you can take a little risk, have a little fun, and really find things that you think are unique, and really capitalize on those kind of big ideas. And hopefully we can bring stuff like that to the platform this year for you all to invest in. That's a good lead into the last one, which is operational complexity. So for lack of a more appealing term, you kind of want long-term rentals to be boring. You want them to look good. You want the residents to love the home, but you also don't want to go back and forth a lot. You don't want to turn the house over a lot. You really just want to have someone sign a lease, ideally stay there for multiple years, and not have too much lift there. Versus vacation rentals, tons of operational complexity. And to give you an example of also what we think about, even when we're buying vacation rentals, we really have to think about things like lot size, things like that. So if a vacation rental is on a huge lot, and it has a ton of foliage, or it has a massive yard, or it has a long driveway that we're going to have to plow in the winter, things like that. All of those things add to the complexity, and we factor those in when we buy. That's not to say that nothing we buy is going to have challenges, but there's a lot of things past, how many bedrooms does a house have, how many bathrooms does it have, that we really kind of dig into and say, hey, this might look good, but what about how much money we're going to have to spend due to all these challenges, operational challenges the property is going to have. The next one, asset type. So this is, going through this kind of more quickly, and some of these are going to be, focusing on things we addressed already a little bit. I'm going to go through LTR first, and then I'm going to go to vacation rental. So, obviously long-term rental, so far, we only have suburban single family, or I guess some might be urban single family, but so far we only have single family. We will potentially maybe look into multifamily at some point. That's probably an area of an expansion for us. Typically, I think what this is describing, though, on the LTR side is these assets are going to fall within a very specific formula, and that's good. Again, you want them to have certain assets or have certain features that are going to appeal to a broad range of people, because that's going to let you get the most rent, and that's going to keep your occupancy the highest. And rent level plus occupancy is your goal. You want the highest rent you can get, and you want the most occupancy you can get. Clean, safe, functional, cookie cutter. Again, I think I used a little boring last time, but yeah, I mean, you want a house that's going to appeal to the most people, right? In long-term rentals, you don't want to be too bold, because you're going to appeal to a few people, but you're also going to turn a lot of people off, and that hurts, your length of time to lease, et cetera. Core markets, but deployable anywhere. This is true as well. There is a need for long-term rentals almost everywhere. So there's a lot of opportunity for us to expand into new markets. Hopefully we are going to be releasing a lot of new markets in 2023, expanding throughout the country. So I'm excited about that. Vacation rentals. I'm going to focus on lots of asset profiles, work, and unique. Again, kind of reiterating the last slide. So really the world is your oyster in terms of short-term rentals. You can really, and vacation rentals, you can buy a lot of different things and offer guests really unique experiences, which that honestly is a lot of the sales pitch of vacation rentals, is offering them something unique. There are vacation rentals that just compete on a straight up heads in beds. It's cheaper than a hotel for me and my 16 friends kind of way. And we'll probably get some of those guests as well. But that model is a little more risky in my opinion. Because if you're not offering something unique, if you're not giving them a unique experience, I just think your product is a lot less competitive. And as the vacation rental market grows, I think the ones that are going to succeed are the products that are unique and competitive. Those are the ones, something that offers people an experience as well as a place to sleep. In addition to hitting all of your like needs, those are the properties that are going to really succeed. Also, they tend to be smaller markets. So in terms of asset selection, one thing we've been thinking about a lot here at Arrived is, obviously during the pandemic, vacation rentals really exploded in popularity. And so we're really trying to sort through the locations that we believe are going to be the winners versus the ones that may suffer a little bit in the, receding trend of vacation rental, exploration. So there were a lot of places that really had explosive growth. And, myself and my team spend a lot of thought on which of these markets have long-term secular growth trends and which of these markets may struggle for a year or two as they adjust to the higher inventory. To operating model. So I'm going to go through this a little more quickly. Long-term, you have a longer lease, a lower investment. I will stop here for a second. So on long-term rentals, we do focus on a lower investment. We don't want to put a ton of money into the homes. So as we're searching for homes, we look for, we call it internally hardened homes. So we really like to see things that have been freshly painted, that have new floors, that have the HVAC replaced, that have the roof recently replaced. So when we're not buying brand new properties, we are looking for homes that have an effective age that is much newer, potentially than the build year. So, a home that was built in 2006 that has just had the roof replaced and the floors redone, that's a really good asset, right? Structurally, it's going to be sound, and the interior is going to be nice and updated. And ideally, in our 5 to 7 year time horizon for long-term rentals, hopefully we won't have any major expenses there. Scalable assets and ops. This is something we're gonna be challenged with and faced with. Long-term rentals are easier to scale by far. You buy them, you put someone in for a long-term lease, and then it's not easy to scale, but it's much easier than vacation rentals. You hopefully don't interact with the tenants a ton once they're in there. You just kind of solve the problems and off you go. As an investor, for you guys, lower volatility cash flow. So your cash flows are going to be much more certain in the long-term rentals. And how we think about that as well, just from an investment standpoint and a selection standpoint, you can also think about properties that are smaller, like a 3 to 1,500. Those are kind of your bread and butter, everybody roof over your head kind of asset that is going to have less of a difficulty leasing versus a massive 5-bedroom kind of asset that's like nicer inside. Both of those are good rental opportunities, but there's going to be lower cash flow volatility with a smaller asset. Quickly on vacation rentals, I'm going to focus on the volatility and the high initial investment here. So we really are trying, speaking to earlier, the experiences, we are really trying to invest a lot in our vacation rentals to make them really, really good assets, memorable assets, marketable assets. That is going to, A, get us the most revenue in today's market and in any market, making it the most competitive. And B, it's going to protect us from any sort of event where, an area gets oversaturated potentially. The assets that are going to have trouble are just the ones that have the lowest effort, lowest investment, least experiential for the guest. Higher cash flow volatility. So for sure, we also look for a lot of upside on vacation rentals. So, I like to think that we underwrite pretty conservatively on our vacation rental cash flows. And, we're hoping to to really invest a lot of that money, as it says here, to really achieve outsized returns. You know, we really want to be at the top of every market that we enter. But that cash flow is going to be seasonal. You know, it's going to be obviously in the beach markets, it's going to be really high during the summer, and in the winter, you just kind of, you know, muddle through. And conversely, with ski markets, it's going to be the opposite. So we do have higher cash reserves in those markets to get through those times too. So that's another kind of way we look at the differences. Finally, long-term rentals. This is a great, the first point on long-term rentals, be near construction cost. That's a fantastic way to look at it if you really zoom out and you kind of ignore, you kind of ignore the trends and the interest rates and some of the noise. If you're buying something at or near what it costs to build it, you should be in good shape. You should be in good shape long-term. So, you know, we are focusing on some newer builds right now and hopefully buying, you know, near construction cost. And those properties should do fantastically because you're getting an asset that hopefully doesn't have a lot of repairs needed. And also if you're buying it for near the build cost, you should be protected against the downside. Same with investing in lower price points. We're also investing in entry-level housing right now. You know, a lot of the economic talk right now around a pullback, a lot of that is being felt at the, you know, mid to high income levels. You know, people's investments are down a little bit, things like that. And that's really going to impact the, you know, 2,000 to 4,000 rent range. It's going to impact the, like, you know, not luxury by any means, but certainly the higher price point homes. So we're really focusing on lower price point homes to get in there and get the tenants that have been less affected probably so far in the current economic environment. Close to infrastructure, balancing cash flow and appreciation. Some markets are better for cash flow and some are better for appreciation. We try to offer both of those on our platform and let you guys choose which are more important to you. You know, as an example, a lot of the Arkansas properties and the Alabama properties, those tend to be a little higher on the cash flow versus appreciation. And then you have the Nashville properties, which may be a little lower on cash flow, but have much higher appreciation potential. So that's kind of giving you that idea. And it's not that we favor one over the other necessarily. We try to give a balanced approach so the investors have a good chance to get both. I've said this a lot already, but yeah, for vacation rentals, uniqueness is great. We've talked about that. The bigger, the better. This is an interesting one. You know, when you think about the world of vacation rentals, and if you think about who's going to say the go, no go for booking a VR, you do want to push your vacation rental to have as many guests as possible. You want to put as many people in a home as possible, or at least have that potential. And because of that, what I try to lean towards is the number of bathrooms. So if we can find a property that has a lot of bathrooms, that's great because for an experience for a vacation rental, probably gets pretty eroded if you have 12 to 16 people in a home and it has 2 bathrooms. That could be a little difficult to deal with. So we do want big houses, but we also want to make sure those big houses have restrooms, parking, you know, different things that make the house actually be able to have that many people in it and be comfortable. The common spaces as well. And then maximizing revenue. I think we're going to spend a lot of time this year, you know, now that we're really deeper into the business, thinking about really how to optimize revenue around events, around the calendar, seasonality, and really trying to drive that outsized revenue that's hopefully going to be above and beyond the underwriting. So hopefully that gives you guys a good look into kind of how we select and the different factors between the two. And I will invite, I think, Corinne back on stage to take us to Q&A, I believe.
Wonderful. Cameron and Jeff, thank you so much for your prepared remarks. Cameron's hopping back into the virtual room here. I'm going to pull this deck offline. We have a whole host of questions. I know Jake is answering in chat, and then we have a ton queued up for live Q&A. So thank you all for joining us, walking through all things property selection strategy. I did see the first question in here along the lines of how do you name the properties? Is the property the Corinne named for you, Corinne? I can take this question, then we'll hop into a few more. So I shared in chat, we name our properties after a myriad of different things. It could be a street name, a baby, a family member, a whole host of different names that we have. And like Jake said, if you have any property suggestion names, feel free to drop them in the chat. We love to hear about them. We're going to have a page in the future where we actually have the why behind why properties are named what they are. For the Corinne in particular, a little backstory on Arrived. Every quarter we do a value award. So essentially your team votes on one person within the company, and then they get to have a property named after them. So I was lucky enough to be voted upon the last 2 quarters, or a quarter ago. So I'm so grateful to walk alongside our folks that Arrived, and also all of our investors. You'll notice there is a Jake property as well within our property. So anyways, we'll move on to the meaty questions here. There's one in from Cynthia. What about midterm 30-day plus with HOA restrictions, distaste for the short-term rental market? Cameron, I'm going to kick that one to you.
Yeah, I think that so if we're talking about a different market, right, we're talking like a short-term, medium-term rental, right? Something like that. I think those are interesting, and it would be a completely different investment model, in my opinion, because I imagine something more like a traveling professional who would need that length of time. I think there's probably also other use cases where call it 1 to 6 month occupant is looking to lease an asset, and I think he can probably make a business out of it. My guess is that it looks more like studios and 1 bedroom, 1 bath, like tech enabled flats or something that are close to public transportation. As we look at multifamily, as we look at other urban cores and major cities, I think that these opportunities will pop up more. So it's distinctly different, in my opinion, than, say, what a vacation rental is, even though they're both not long-term rentals. So just got to find the right use case, the right niche. I don't know the right way to say that. But we're more focused on the residential vacation rental experience. But I certainly would agree that like that use case of that short and medium term does skirt some of that short-term vacation rental stuff that is very problematic, even if you could do it as an investor owner of a vacation rental, or a short-term rental, I should say.
Wonderful. Thanks for walking through it, Cameron. I saw one in here from Mark, which is very pertinent for some of the prepared remarks, Cameron, that you walked through in terms of the process with the SEC. They mentioned you had stated turnaround time with the SEC is now in a 1 or 2 week turnaround for approval. The Corinne, the Sunnyside, and a few others have been in coming soon stage since December 2022. Is there an issue with this, or what is the SEC's response behind this?
Yeah, that's a great question, and 2, that's very observant of you. So appreciate you being vigilant over our inventory and our site to kind of make that connection there. So so it is, 1 to 2 weeks that has been the cadence. Specifically with the drop at the end of December, it was the first time that we were submitting financial audits for all of the investment vehicles. So our third-party auditors, we had worked with them to prepare the audits, and it was a big effort. So it's really, from my point of view, just the growing pains of dealing with the SEC in more of a scaled manner for the first time, right? The process of getting them qualified when we're offering them, saying like, hey, here's this property within this company, within this offering. That's the 1 to 2 week turnaround. The issue specifically on the coming soon properties you observed is that they were just part of the batch of the entire issuer, which means all 200-ish securities that we've offered. They're saying, okay, let's review the audits a little bit more deeply, and that's what the hang up has been on those specifically. Now you will see that some properties have hit the platform recently, so for short-term rentals. So just kind of what's going on there, right? Like, why do some properties come up? Why, versus the other ones that were still in coming soon? It really has to do with this idea, without getting too deep into the woods, of issuers. And issuers are basically, there's an agreement that you're signing when you're purchasing your investments, that is basically an agreement with the issuer. The issuer has documents. So we have multiple of those, and the strategy for Arrived is to keep growing that. So we'll have multiple channels to keep offering properties over time, and it's just part of the growing pains of being in growth mode and still figuring things out in the marketplace and what works, and trying to be transparent with the SEC. But that's pretty much the full explanation, though, of like, hey, what's the delay been for 5 weeks now on this batch of properties?
Definitely. I'm going to share a recent blog post. We posted this at the end of January, a little bit more behind the scenes on the SEC, if y'all would like to take a look at it after. It is a process we are very proud of, though I do understand the want and, to invest in those properties that we have coming soon. So definitely more to come in the next few weeks, but appreciate you asking, Mark, and keeping us honest on the timeline. I saw another one in here from Cynthia. Please share markets you foresee struggling versus stable or rising. I think this is going to be a combo. Cameron, I'll kick it over to you first. And then Jeff, would love to hear your insights as well.
Yeah, so foresee struggling. Yeah, as a generalization, it's going to be the markets that got overheated during the run up throughout, call it the first couple months of 2022. When the events kind of geopolitical started breaking out around the world, interest rates started going up. At that point, there was limited time left in how much fuel that the real estate market had left. So some of the markets, more so in like coastal areas, top tier metro areas, they got overheated because leverage was super cheap. So when interest rates are really cheap, property prices get high really fast because you can qualify to service the loan, you meet the income requirements, you meet the underwriting at lower interest rates. So I would say that those markets that got overpriced are going to be the ones that have the biggest mountain to climb. After whatever dip we're experiencing or is coming is done, they'll be starting at a lower point relative to where the peak was than, say, other markets that started off at a lower prices base, right? So imagine a market that's like a $250,000 home market. It'll climb up slower than a market whose values are at like $450,000 the average home. So like just from a dollar point of view, it just kind of amplifies faster. So that's what we found, is that those markets, and Jeff can probably speak more specifically to which markets in particular, some of which we bought a couple properties in and then pulled back, some of which we've been looking at and made the determination like, no, we just shouldn't go there. Austin, Texas comes to mind as one of those overheated markets. And I'm a Longhorn, and like my family lives in Austin. So, nothing against that. It's just, challenging from an investment point of view. But as far as markets that are also kind of up and comers, I think Jeff has a good pulse on that too. So I'll turn it over for that.
Yeah. So in terms of long-term rentals, I think everywhere that saw the highest appreciation, the Boise's, the Austins, Phoenix a little bit. Some of those markets will struggle, but I think a cooler way to show or speak to what I was talking about in my part was, you think about the pandemic and everyone really wanted to get out of town. Everybody wanted to go to the country and go to that unique place and be in a cabin and be in the woods. So I think what we're thinking about is contrasting a place like Broken Bow, Oklahoma, which we actually just launched 2 properties. Broken Bow is, really close to major population centers. It's been a place that people have wanted to vacation for, a long time. And it is a kind of a nascent market. So it's going to continue to grow. And you contrast that with, there's some much smaller, more niche markets that probably got a little out of hand because there was, 15 Airbnbs there. And then all of a sudden there were 200 in a year. And those are the markets that we're trying to be really cautious in. And I think there could still be opportunity in some of those markets. Like we could have discovered brand new markets and created brand new markets. But that's really where, as an investor, you have to be careful, because if revenue comes down 30% in those markets, that the house really is worth 30% less as an investment almost. So we really have to be cautious in the places that spiked, unreasonably high, and are smaller and really don't have like a long-term secular reason for that area to grow.
Wonderful. Thank you both for walking through it. I also saw Mark in the chat recommending a few different names for properties we have coming or in the future. The Pink, the Council, or the Floyd. Some great recs in there. Definitely appreciate it. And Mark, quick note, I know you had a tough experience with the notify me and not receiving a text. So I did shoot you an email to help troubleshoot and improve your experience for our next release. So thanks for keeping us honest and letting us know. We are looking to improve that for the future as well. Grateful to have you on board. I did see one in here from James, and I know that Jake had answered this in the chat, but I think it's always good to walk through live. Cameron, you touched on this in prepared remarks, but are homes fully leased before SEC qualification?
Yeah, it does depend. They do have the processes happen in parallel. So after we complete due diligence, then we look to introduce that particular property into a securities filing, which then initiates that 7-ish day process turnaround. But in the meantime, once it does pass it, we still have to prepare documents on our side. So we work with our legal counsels and get all of our internal underwriting figures and just the full spectrum of information that we need to file. We stitch that together as part of an offering and then submit that to the SEC. So I review that because it's a variable timeline. Right. So sometimes we close on properties. Maybe there's a quicker closing from due diligence to closing. Sometimes is as fast as, 5 days, 7 days. Right. Because once we do have our due diligence, then we're like, OK, we're good to close now. Money is not so much an issue. We're not taking property subject to financing and getting loans. So we can, quickly close, and we just don't need that time. So at any rate, if that happens, and let's say it's a new construction home, it's ready to go, we start pre-marketing it, get somebody in, it could be leased by the time that we have a property there. And you'll see that say, well, I don't want to spoil it, but I think I did already say it in the video. So the Sheezy is already leased, and it's been a coming soon property. So when it is available, it will be leased. So that, a lot of properties may not be. We're also working to add properties that are existing leases, that have existing leases. If we like the economics of them, if they're managed well, we may obtain economies of scale by buying out small portfolios from sellers, right? So if you were to procure them individually, you might get the market rate of return. If you were to buy a package of 6 from an investor who's looking to exit all 6 at one time, that's where opportunity exists to get some sort of discount that you might not find otherwise if you piecemeal it in the market and kind of reconstruct it. So we're working on, there's some securities implications, there's some legal issues that we have to get through and structuring things, but that's definitely on the roadmap for us because we do want to have a certain cadence and stability that when properties come on, it's like, hey, it's clear what the economic expectations are, whether it is leased or not, but we would like to have more cash flowing properties hit the property and you're generating cash flow day one. So all part of the greater plan, but a little bit of context on why variability does exist.
Definitely. Yeah. I know vacancy is always a great piece to talk through, or even leasing strategy as a whole. I did share the example that Cameron walked through, the Sheezy. On all of our property pages under tenant leasing process, we showcase the rental status, first dividend date, and first dividend yield. So that rental status will be updated throughout its lifetime, and that can fluctuate. But I always appreciate the question, so folks have an idea where a property is sitting in what stage as well. So thanks for walking through it, Cameron. Cynthia has a great question. It's along the lines of financing strategy, and I know we were talking about this moments before we jumped on the webinar. So would love to talk through ideal debt, asset ratios. I think this will be a combination. I'll kick it to you, Cameron, first. But Jeff, I'm sure you have feedback on this as well.
Yeah, so debt to asset ratios. I'll speak a little bit to our philosophies on leverage, and then Jeff can talk about some of the observations about the impact that different interest rates have had on, say, the economics and why maybe you see more cash right now on the platform than levered investments. So as I was talking about in the prepared remarks, debt is more than just a means to an end, right? Debt is a way to amplify returns. It's a mechanism. It's an economic tool. So in terms of ideal debt to asset ratios, it's, from our point of view, it's an exercise that has 2 considerations. One is that economic return, like I'm talking about. But two is also a certain amount of risk mitigation, an element of, can you sleep well at night? So we take on conservative leverage, very conservative by real estate measures. When you are buying investment properties, when you are talking with flippers or wholesalers, they are levered to the gills. And when I say to the gills, I'm talking 90 to 97% leverage for their investment. So a lot of the stories from the Great Recession and 15 years ago of people losing properties comes from bad debt and over leverage, kind of a 1-2 combo of just poor underwriting and just poor credit worthiness. So we like to take a conservative approach, not because it necessarily like we're squeezing every penny out of the optimized, equation, but more so it's a good balance between how do you deliver the economic power of levered equity appreciation that it offers, but we don't want a highly levered product. I just don't think that's just not a good take for what we're going for right now. So it's the balance, and where we end up with a lot of our leverage is, call it as a general rule of thumb, anywhere from 40 to 65%, depending on the investment. And that's not an always thing. So I'll turn it over to Jeff in some of the nuances of like, well, what does it mean to be like, ideal for debt asset? And that might be specific to you, but what have we been seeing in the markets and for both long-term rentals and just the impact on cash flows and things like that?
Yeah, I think you did a really good job of covering most of it. I'll just say that with current interest rates where they are, it really does stress the cash flows of the assets, and we want your assets to cash flow and appreciate. And also, when you think about, I mean, again, Cam, I had a very similar response to, our leverage is much lower right now. Leveraging at an extreme rate, which again is very similar to what you hear from a lot of people who talk about BRRRR investing and refinancing and all this stuff. They are leveraged very aggressively because that's how you grow a portfolio very quickly. But it's also how you get out over your skis and run into trouble. And I think we've done a good job of kind of pivoting our strategy as interest rates changed, as cap rates changed, et cetera, to make sure that we are trying to capture excess returns by leveraging where possible, but in times when it doesn't make a ton of sense to, or where it makes sense to do something like go ahead and buy in cash and then wait and potentially do a more opportunistic refinance. I think we're really doing right by investors that way.
Wonderful. Thank you both for walking through it. I know there's a lot to that, so always good to walk through. I did see one in here from Anthony. There are several properties which have been fully funded for quite a while. However, they have not yet been rented. What is the strategy on these properties? Early sell, lower rent offering, different restrictions on renters and time frame. Cameron, I know we just walked through this. I think it was last week on a webinar. So it's always a good question.
Yeah, definitely. I'll go through our portfolio as a whole and address a couple of these properties individually, and then so at a high level, there's, I think, two things going on. One is seasonality, and two is rent levels. So I don't want to chalk everything up to seasonality because there's kind of an overall dynamic. So let's first talk about like the price point. I think one of the problems with one of the challenges with investing in larger assets is that the long-term rental market can be thinner. So if you're trying to get a rent that's like over $3,000, there's only so many people in the market that have the appetite for that. And maybe they have to find roommates, or you have a young professional situation, something like that. But it's just a little bit of a thinner market, even though like the bet can still be good, right? So we have to kind of separate the idea of rental economics versus the totality of the investment thesis of it, in itself. Because what if you get that property for a really good deal, but it's hard to rent? You still probably want to buy that from a capital appreciation point of view too. And maybe that influences the leverage and we put it on that. But at any rate, back to the vacancy question, I first want to like illustrate that high price points have thinner demand. So it just magnifies the impact of seasonality, which we can talk about now, where on long-term rentals, you typically have two seasons, a hot season and a slow season, and generally split it out as 6 months and 6 months, right? So the problem properties specifically that I think you're referring to, they are a combination of both of those. They are both properties that have higher rent levels in good locations, mind you, though, because there's certainly no way that you can get that kind of a rent level in a not good location. But they're high rent levels, and they are, well, they were coming online at a time when it was transitioning into a slower season. So call it from August transitioning through September. It's kind of a tough time to be in. And if you're not leased out by then, brace yourself for a slower season. But Jeff, do you want to speak more maybe about to like seasonality, price drops, and tactically, how do we manage a vacancy cycle to make sure like we're not overly dropping, but we're still like measuring the market?
Yeah, yeah, certainly. I know from experience. So really quickly speaking to our team has a lot of experience in this. In the same way Cam said, he trusted me a ton in terms of valuing things. We have a team on board that I trust a ton in terms of pricing our assets, underwriting, and understanding markets and like the leasing dynamics. So we are constantly looking at our stuff on market and adjusting it. It's very tough to lay out a specific strategy because different markets have different things, and I can't speak to an exact table of how fast we would reduce something or how fast we would offer a concession, because that's going to depend on how many other options that are in the immediate area, et cetera. How much demand there is, how much inventory there is in the market. But I do think we take a very proactive, iterative approach on our properties that are on the market. And we do look to lower rent where appropriate. We do look to concess where appropriate. And, we are now out of the tougher leasing season into the better leasing season. So the hope is that you should see some really good progress on the things that have been a little stale. And we should see very fast leasing, ideally over the next 4 to 6 months. And that's just kind of the nature of when people move. People want to move when it's warm outside. People want to move like right before school starts or right after school, so there are certain calendar things you can't avoid. And yeah, we really put a lot of time internally into managing our on the market assets and moving rents and things with trying to get things leased.
Wonderful. Yeah, there's so many pieces to that. So always appreciate the question. Anthony said, thanks for addressing. Understand that there are outliers to the general strategy and appreciate you taking the question. So thank you both for walking through it. I did see a few questions in the chat that I'd like to mention live. So we are currently working on a mobile app. We're hoping to release that soon. Plus 11 that will make notifications a heck of a lot easier. So more to come in that space. As well as Jake also mentioned cash accounts or uploading your funds to arrived, monthly dividends, so on and so forth. That is something that our team is working on. We don't have a definitive date of release for that, but know that we are building for and by you. So keep the feedback coming in chat, whether it be an experience in the UI, a market that you would like to see, asset class, so on and so forth. We would love to hear from you all to make sure we're hitting the mark and growing alongside you. So keep it coming in the chat. I did see one in here from Chad, and it's actually right in relation of what you both were just talking about with like seasonality and how we handle that logistically. So how are dividends decided? How do they fluctuate? And how do they differ between long-term versus vacation rentals? Cameron, I'll kick that to you.
Yeah, so let's maybe we can that third part of the question, like how do they differ between long-term rental and VR? Let's parlay that into like a discussion about returns, because that's really what we're talking about here, like the allocation of the two. So how are dividends decided? More or less it's through an underwriting model. And I think that the thing to understand about underwriting is that it's an average process, meaning that it's not trying to model on a quarterly basis saying like, zero income now and then 3 months later this rent, it doesn't time it that specifically. It's more like, here are assumptions that are very likely to be true over a 3 to 5 year horizon, right? So that is kind of the underwriting model, and that is what the presumption for the dividend ends up being, is that we look at a seasoned way of looking at dividends, and then later reconcile to see, are we off or are we like right on target? So as a quick example, let's say that a property is estimated to generate 5% dividend income per year. And let's say that we lease it up within 2 weeks and there's no expenses other than like taxes and the very clear expenses, but there's nothing, no surprise expenses, no maintenance, no nothing from the tenant. It's an overperformer and they pay it every month. So the dividend expectation, was 5%, but it's going to way outperform 5%. So what do we do then? Well, what we do at Arrived is stabilize. So we stabilize the expectations and the cadence, because realistically, that 5% could still be right. Like that number, I could outperform for 2 years. And then after 2 years, it's like, bam, all the expenses hit. And then when you look at it, when all is said and done, 5% was right. So it's hard to say in the moment, and distribute it as the cash flows are coming in. But the way the dividends are calculated is that it's on an assumed average stabilized basis. And that's how we distribute cash flows. But then there is a reconciliation process that's needed. So let's say that house, instead of having expenses later, it just kept printing cash and cash and cash and cash. Okay. It was the ideal situation. So what we would do then is reevaluate that dividend on, call it, an annual basis, and say, hey, this cash reserve is getting a little bit heavy. We don't need all this capital sitting in here. Let's up the dividend from 5 to 6.5. So then at that point, we recalibrate the payment schedule and say, okay, let's narrow down the cash reserves because we don't need to be accumulating that much. And that is, and we'd also make the kind of inverse decisions too, saying like, ooh, this property is not performing that well. Cash hasn't been coming in at the rate we thought it would. We have to lower the dividend to make sure we have a cash, so we don't eat through our cash reserve, because we need that cash reserve to make sure that we can pay for the AC unit if it goes out in the middle of July in Georgia. So that's how we manage it. But the underwriting process is really kind of that stabilized idea of what it is. And that's how we handle it for both vacation rentals and long-term rentals. Difference between LTR and VR. Yeah. So I think this is an important discussion, but I'll try to keep it at a high level, because this can just go in too many directions. It's like, if they're the same asset class, residential homes, what are the differences in the investment profile, and like why one over the other? So, Jeff went over extensively the details behind the two, but I think that like I'll hone in on two details. One of them is the upfront capital investment. So on a vacation rental, let's say you buy a house for $650K, but we're going to put another 250. Let's call it 700,000 to make the numbers easier. And then you're going to put $300,000 of updates, renovations, hot tubs, design, artwork, forks, into that property. So that $300,000, you're not recouping that when you're, in a real estate sense. So when we talk about appreciation, we're not talking about appreciation on forks, right? We're talking about appreciation on land and structures. So there's a heavy investment into a part that doesn't appreciate. So that doesn't sound that appealing, but what's the quid pro quo here? Well, the idea is that you get a lot higher rental income out of it, because people will pay for experiences. I always think about Disney when I'm thinking about vacation rentals, because it's like they make experiences almost better than anyone. They can monetize it, right? So you take that approach to vacation rentals, and that's what we're attempting here, right? And that's the investment thesis. So you're going to be heavier on cash expectations and returns for vacation rental. But there's also the upside that this is a residential asset that, when mortgage rates are cheap, or if we have 40 and 50-year mortgages and people can afford payments again and purchase prices go up, well, you have a big asset that's probably going to appreciate on the back end as well, very similarly to our conception of what the long-term rental industry would appreciate at, because we're operating the same residential assets. So it's a difference in expectations of where you get the returns. So on a long-term rental, as Jeff said, you're buying a commodity, it's empty, people bring your own furniture, you're just collecting money on the land and the structure. So as such, you're participating in a little bit more commodity returns. So the income can't necessarily be super outperforming, but where we can outperform is on the neighborhoods and the homes that we select on a longer term basis. Because if we pick the right areas, and if we pick the areas with good fundamental economic growth, fundamental demand, people moving there, difficulty in adding supply to the market, the properties are going to go up. That's just what happens with real estate. So that's a little bit of, how we think about the return profile differences and what you're betting on when you split it off between, you say we have two different investment products, but it's the same single family residential house at different price points in different neighborhoods. That's the difference.
Yeah, thanks for walking through. I know it's a multi-pronged question. Appreciate how you dissected it, Cameron. I did see one in here from Jill. Jeff, I'm going to kick this one over to you. Do you employ the same financial criteria for all LTR markets, or does it vary market to market? So for long-term rentals, and think like cap rate, all those other, variables across different markets for that asset class.
So at a very high level, I'd say no. We don't have the exact same criteria for all of our markets. We're looking for good investments relative to markets, right? So if we believe in a market, a good investment in a market is going to be different in Chattanooga, Tennessee versus Tuscaloosa, Alabama versus Albuquerque, New Mexico. They're just going to the price at which things are trading at is going to necessarily mean that returns are different some places. If we were to buy, I'm going to use a place we're not going to buy or we haven't bought yet. I shouldn't say not going to buy. Like Los Angeles, California, you probably cannot get cap rates that are similar to what we're buying in the middle of the country. Those could still be good assets if they appreciate a lot, but the cash flow is going to be much lower there. So that's just as an example. That's just to say we do not have a strict rubric of it has to be this, it has to be that. We try to make sure that the assets we're buying, the hard stats in terms of the returns are in the top echelon of that market, and that the soft parts of the house, which we talked about selection earlier, the little things, the nuances, those are also good. I'd say in general, no. But as an overall rule for our investors, we want to get the highest caps possible. We want to get the highest investor dividends possible for you guys.
Wonderful. Yeah, it's a great question, Jill. Thanks for floating it our way. I did see one in here from Christopher. It's great to see you here today. I know we chatted a little bit behind the scenes and offline. So Cameron, I'm going to kick this to you first. I'm sure Jeff will have more details as well, but we were talking about actions on loss. I understand all properties are appropriately insured and your actions will be a case-by-case basis, but I do believe you have a primary and alternate course of action. How would you prefer to handle a loss regarding a rebuild of the property or investor buyout from penalty or early sell?
Yeah, maybe a little bit first on that last part. I think that if there were some sort of insurance event where a disaster happened and we're facing that prospect, that's not something ideal. So, the idea of like penalizing investors or something for, made the decision to sell, I wouldn't worry too much about those details. I think that we'd approach it in a very like fair, democratic way that's like it takes everything into consideration. On the first part about, do we rebuild or do we sell the lot, take the proceeds, right? That's kind of the question here. Do you take the money and run and cash everything, close it out, or do you rebuild it? And I think it really depends on where you are in the cycle and what is the value of rebuilding versus what is the value of just selling the lot. So let's say that we have a particular, insured value, but the market value is higher. I'd probably rebuild the house because there is a advantage to having the asset versus the payout of the money. And the opposite is probably true too, right? If it's not worth it because for whatever reasons, we're down on the asset and it would just take too long and just not be worth it to climb out of that hole, I imagine we could make the decision to cut our losses and take the insurance money. So to me, it really depends on what is the market value of the property at the time the event happens. But knowing that there is a trade-off, because if you're going to rebuild an asset and have to deal with insurance, that's a 9-month time frame we're looking at here. Now, hopefully it was leased at the time, because let me take 1 second to plug our insurance product in that, yes, you are probably familiar with the insurance products on your home, but additionally, we have commercial protections specific for kind of our business model, where if we have a lease on a property and then we have to exercise a claim and use the insurance, they'll continue to pay us the rent for the term of the lease. And we also have 2-year leases that we generally sign. So it's possible then that it would be very worth it to rebuild, because during that whole 9-month time frame, if the lease had extended beyond that, we're getting paid too. So I put that out there as kind of one of the scenarios where our insurance strategy really pays off, because it makes the situation easier too from an economic perspective. It's like, if you get paid and you're getting paid to rebuild, sounds pretty nice to rebuild. And it's like, hey, give me the asset. So that would also color our decision.
Wonderful. Thanks for walking through it, Cameron. Christopher, if you have any clarifying questions, definitely let us know. I know we're a little bit over the hour here. Before we close out for today, I know we had one poll question, Cameron, around what is the next residential vertical you would like to see? So I'm going to go ahead and share that now. Can you add a little bit of color around why this question and what you and the team are thinking about?
Yeah, definitely. So there's so much opportunity within residential real estate, and we're looking to bring different sets of investment opportunities to Arrived. So not only, when you think about what we offer on Arrived, we kind of start at the end of the value chain when it comes to a residential asset. It's usage. It could be an owner occupant, it could be a rental, or it could be a vacation rental. So that's really where we're capturing and bringing opportunity to the market. But back your way up into that, and now we have flipping. There's plenty of properties that are condemned, that are in a state of disrepair, that need to be added to the market, because we do have a housing supply issue in the US just generally, right? So flipping, new construction, those could be call it new investment products, where we're just going up and up and up the value chain of being able to transform real estate. So that's really the idea here, right? To stay within residential, but also to offer more opportunities than just the end use case. And maybe talking through some of the options, flipping, that might be one of the more commonly understood business models within value add. You take something in a state of disrepair, go through the effort of construction and improvements, and then now you have a much more valuable asset. It's tough, but I think we're all familiar with it. Land development, this is super interesting. Land development is, take one really big piece of land, make sure that the county gives it the right set of rights, and then divide it into more pieces of land. That's kind of the land development component. And then as you go further up, then it's like land development to construction. Well, we have this nice piece of land that the county says that we can put something on, and we have utilities going there. So who's going to do the building? Well, maybe that's the construction fund then. And then let's see, funds of assets. Now take any one of these business models and say, well, let's make a fund out of it. So any incremental project I'm getting a little bit of exposure to. So that's some of the ideas behind kind of residential verticals. I know that funds may not exactly be the same apples to apples as considering flipping and land development and construction, because those are really more the processes, whereas a fund is more of a structure. But nonetheless, just interested in seeing where there's interest in taking the next step of value add.
Definitely. Thanks for adding more color there, Cameron. It looks like land development just skipped ahead at 43%. Folks would like to see that. Oh, we're tied again at flipping, 40% both ways, 13% funds of assets, and then 1%. And I believe we had somebody share in chat too. So feel free to come in or leave your feedback in chat. Would love to hear from you. Also, we'll give it a few more seconds. If we missed any questions in chat, definitely let us know. I know Jake was rocking it in there, but we want to give a few more seconds. Any closing remarks, Cameron, that you have before, and Jeff, before we close our virtual doors for the day?
No, this has been an awesome audience. Great questions. Really appreciate everything. Love how chat always just blows up at the end. So this is the best part about coming on here every week. Wonderful.
Jeff, any closing remarks from your side?
Yeah, no, thank you. If you guys go to multiple webinars, you may have seen Cam's face. I don't do a lot of these, but it's always fun. It's always fun to get on these, interact with our investors, and explain, why I think I was an investor in Arrive before I was an employee, and I love the company. And I'm just excited to share this stuff with you guys and buy the best stuff for our investors.
Wonderful. Jeff and Cameron, thank you so much for your time, expertise, and sharing all the info today with everybody on the line. For all of the folks in the chat, thank you for joining, for your feedback, questions, and being so engaged. It makes these all the more fun. Andrew, I saw one question in here. Any thoughts on adding auto investing, including reinvesting dividends? Yes. For folks on the line that are brand new, we distribute dividends on a quarterly basis 4 times a year, the month following the quarter. We are looking at monthly in the future, but also implementing cash accounts where essentially you'd be able to upload funds directly to Arrived. And then also those dividends would just sit within your account to be redistributed. And then hopefully making it so you can auto invest based off your preferences. So more to come in that space. We don't have a definitive date of release, but keep the feedback coming and questions. If anything comes up post-webinar, support@arrive.com is the best email. We also have a chat function in the bottom right-hand corner of our platform. But thank you all for joining today. Jake, thanks so much for all your work in the chat. Appreciate the thumbs up, Ronnie, Jill, Andrew, Anthony, everybody on the line. Hope you all have a great day.
All right. Thanks, everyone. Take care.
Bye all.
Yep. Thank you.